Hello everyone, in this video we will be starting with a new series which will be on stock price data analysis. Again, this is not any kind of this video or any video in this series is not any kind of investment advice or anything like that. Please do your own research. These videos are only for educational purposes. So let's get started. What is the agenda of today's video? So as I said, this video will be the basis of the series. So here we will be doing all the basic stuff that will be the foundation. So first we will see how to convert a column into date time pandas and then extract different information like day, month and year. We'll be also looking into the candlestick charts, not very deep, but definitely we'll be having a basic understanding. Then we'll be calculating and plotting returns. How we calculate that and how we can use that is also will be something that is discussed. After that we will be using groupings. Then we will be finding cumulative returns and what those are we will be seeing, and lastly we'll be talking a little bit about volatility. So let's get started. I have written all the code beforehand so that we don't waste time over here. We will be importing the basic libraries like NumPy, Pandas, Matplotlib, and we will be using Plotly for the candlestick chart. We will be using this library a lot in the next videos because this is the best way I have found of plotting candlestick charts and working with it. So this link is where our data is there residing. I'll be giving this link in the description, so don't have to worry, just copy paste. You will be reading the CSV file. The shape of the CSV file, as you can see, is over a little bit over 4,000 rows with 15 columns. So if you print the head of the data set over here, you can see that there are certain columns. So this is the date column that I was talking about. We will have to convert it into date time. So rest everything is not very important. We have to focus on open, high, low and then close. So these are the four columns that we will be needing, and for the other things we can just skip those. Okay, after that we want to see where are the null values. So in the columns that we want, that is date, open, high, low and close, there are no null values. So there are some null values here, but we don't care because we won't be using them. Okay, after that you describe the data set with some statistics. So there are this many columns, as we have seen, the mean and standard deviation and all that. We don't need all of this right now. Now this is the first step. Okay, as I said, the first step is going to be converting the date column, that is this column over here. You can see the date is 25th of August 2004, 26th of August 2004 and so on and so forth. Okay, so we will be converting, this is just in text format over here, we want to convert it into a date time format. So we will be doing that using pd.toDateTime function. We will be using this in every stock market data analysis, so just remember this, we will be using this all the time. After that we will be using the column that we had, that is data of date, and then we will be writing back in the same column. So we are not creating any new column, we are using the same column. After that you can show the data. So everything remains the same, only the data type of this column has changed. Okay, after that what we are going to do is we are going to extract day, month, year. Okay, so what is day? Day is basically first of the month, second day of the month, third day of the month, fourth day of the month, all that. Okay, so for example, let's take the first one. You look at the date over here. What is the day? 25th is the day, then 8 is the month and 2004 is the year. For this one, 30th is the day, 808 August is the month and 2004 is the year. Okay, same thing over here. So basically whatever the date column that we have, date time we have converted, we will do .dt.day. This will give us the day. Then similarly this will give us the month. So let's see the day over here first. After that you can see over here the day is 25th. If you remember from here, if you remember, the first day was 25th. Same 20, then after that 26th, 27th and then 30th. Same here, 26th, 27th then 30th. Again same for the month. You can see over here 888, all of these were August. Year 2004, all of them were 2004. And day of the week, now day of the week is Saturday, Sunday, Monday, Tuesday, Wednesday, all that. So day of the week. Now obviously you'll not be getting text, you'll not be getting TUESDAY for Tuesday, you'll be getting 2 or 3, whatever the representation is. Okay, fine. So I hope this part is clear. So this is how you take out all this is called day of the week. Okay, so 2, this may be for Tuesday, whatever it is. Okay, after that what we are going to, we'll plot the most important let's say chart, that is the chart of the closing prices. Okay, so this is the chart of the closing prices. Nothing great over here, just data.close. You can see over here that data.close, this is the y-axis over here what we are plotting, and data.date, which is the x-axis, as you can see over here, the year 2004, 2006, and so on and so forth. The second important thing is the candlestick pattern. So candlestick pattern, this is how we plot it. We will be using the Plotly library. So for the data, we are going to give the candlestick data. X-axis will be data of date, so the date time, and then we are going giving open, high, low, close. So open is data of open, high is data of high, same thing for low and close. And I'm not getting into slider over here, but basically we are saying X range slider visible is equals to false, which means we don't want the slider. And this is the title, stock prices. So if you see the chart over here, you can see that the stock prices look something like this. So the green are the bullish candles and the red are the bearish candles. Okay, so you can see the general trend, mostly it is increasing over here, then there is a sudden fall. After that, again there is some increment, there is some decrement, but these are not very sharp. But again, there you can see a gap down over here, which means a sudden fall, and then there is a consistent increase in the stock price till here. There is some consolidation, again I'll not say a very sudden, but still a good hike over here, and then the massive fall that you can see over here. These things we'll be looking in the video itself. Just give me 2 or 3 minutes, we'll be getting into that. And this is basically the characteristic of the chart. Now let's get into the most important part, that is calculating and plotting the returns. So I've already made some things over here. So let's say this is our dummy chart. Okay, dummy data. If we are to calculate the return on what is return? Return is like, I invested something on the first day. Let's say 24 hours passed. What is my return? How much money do I get? Let's say I invested $100 on the first day. That is, let's say whatever is the first day, 1st of January, whenever you want. Okay, and this is and how much money, or let's say I bought one stock for 100 rupees. What is the stock worth on the second day? So 2nd of January, if I bought it on 1st of January. So the return, the difference between this in percentage term is the return. So let's say in the fraction term. So the formula is return on the second day. You cannot do return on the first day because that is the day you invested. So return on the second day is what is the price on that particular day, that is P of 2, or let's say on any tth day, the price on that day divided by the price on the last day minus 1. So let's calculate return of 2. Okay, so let's go over here. So let's say I invested $100 on the first day. What is my return on the second day? That is R2. So the formula says the price on the second day, that's 105, divided by the price on the day before that, that's 100 minus 1. So this will come out 1.05 minus 1, that is going to be 0.05. So this is the return on the first day. Now what is the return? This is the return on the second day. Now what is the return on the third day? Now for the third day, you have to say R3 is equals to the price on that particular day, that's 110, divided by price on the last day, that is 105, minus 1. So this will give you some number. Okay, same thing for R4 and same thing for R5. Now in R4, so this is a positive number, this will also be a positive number, this entire thing is going to be a positive number. Now for R4, one interesting thing will happen. We'll use the same formula. So R4 is price on the 4th day, that is 102, divided by price on the previous day, that's 110 minus 1. So if you simplify that, it will become 102 minus 110 divided by 110, that is minus 8 by 110. Now this is going to be a negative number, which means that we have lost some value over here. Our return is going to be negative. So it depends on the stock prices. Okay, so this is how return is calculated. One important thing that you have to note over here is that return is calculated on a previous day. Okay, in cumulative returns, we will remove this previous day to day number. So this over here, we will remove this t minus 1 to just p of 1, which means return on the p of 1 will be the first day, and p of t will be any day which you select. Now we will see that. Okay, just wait a second. So PCT change, this formula that I have shown over here is going to be implemented using PCT change. It's an inbuilt function, so you don't have to worry. Okay, so let's say if you did that and you saved, so you do the returns on the close prices. Okay, and then save it and as another column data of returns, and if you see over here you can see these returns over here. Okay, so you can forget about cumulative returns and rolling volatility. We will be getting into that in the next section. So returns here, obviously the first one has to be nan. Why? Because for the first one there is no previous day, because this is the first day, so obviously it will be nan, but for the second day you can calculate. So the on the second day our return was minus 0.009059, and on the third day our return was minus, again there is some decrement in the stock prices. On the third day you can see we have made some gains over here, and on the fourth day again we have made some gains over here, fourth day 50 whatever. Okay, so this is the return. Now what I want to do is I want to plot it. Okay, so I'm plotting a histogram. You can see all these numbers are very close to zero. Okay, because and this is expected because you cannot get a lot of return on a single day, right? It's not possible on a single day. Let's say on an average day the stock movement is not very high. It depends on the day. It depends if there is something big news that has come out, good or bad, doesn't matter. There will be a spike, and that is something we will be dealing in volatility. But generally speaking, you'll not get a lot of returns on one day. That's why it is said that stock market is for the long term. You can definitely do trading, but you need to be smart for that. Okay, so let's plot a histogram of all the returns. I have taken bins equal to 100. Now this line x lim is basically x limit. What I want is give me the absolute value of all the values of returns. So return, if you remember, there were some negative values and there were some positive values. Obviously you can see over here there were some negative values and then there were some positive values. Just give me the magnitude of that, then find the maximum of that, because that is obviously the np.nanmax. You can say np.max also, but this will not work if you have nan values. So for it to work you need to use the nan max, which will basically ignore the nan values. So removing the nan values, what is the maximum? You take that, then you take the minus of that value to plus of that value as the maximum range, because this is the maximum. Okay, so if you plot the graph you can see over here everything is very close to zero, which means that there are not much of a return on a particular day. However, you can see some certain spikes over here, and you can see some spikes over here. It means that there have been some returns that are huge on one day, but that is very rare. Most of the density you can see is near the zero mark, with zero a little bit to the positive because the stock is mostly increasing, but you can see the most of the mass is near the zero. Okay, so let's see some return statistics. So whatever the minimum is negative 0.5. Negative 0.5 is like 50%. It's like you invest $100 today and tomorrow that becomes $50. So that's a big change. Okay, return, the mean of the returns is basically a positive number, which means there is a small positive, which means overall let's say the stock has improved, and the maximum on a single day that you can get is 15%, which is not that bad. I mean 15% is not like 50% movement, but again 15% is good enough. Okay, now we have got this till here, so this is what we have understood as returns. So now after that returns we had groupings, so let's concentrate on groupings, and you need to understand this diagram first in order to get into the grouping portion. So basically this is implemented using the group by function in pandas. So if you have, let's say, the data, the stock data of let's 15 years, last 15 years or last 20 years, let's say last 20 years, how many times January has come? Obviously 20 times. Let's say you started from January of 2000 and your stock data is till January of 2020 or till December of 2020. Then how many times has January come? 20 times. February 20 times, and all the months in the year have come 20 times. Now let's say I want to see what is the average stock price, the average closing price of the stocks in the month of January. Now obviously there are 20 Januaries, which means we will take all the Januaries and convert it into one group. Okay, we will have this one group where all the stock prices belong to the month January for all the years, so 2014, 2015, and these are the stock prices. After that we'll take a mean of that, so we will be taking all these data and then finding the mean of that. Okay, secondly over here again for February, all of the Februaries of the last 20 years, whatever the data you have will be taken and we will be finding the mean of that. So all the close price, what these values are, these are the close prices. Okay, so let's go back. So over here, if you come and see, that is what we have done. We have used the group by function. Group by what? Group by month. As we have explained here, we have been grouping with month. Okay, group what? Group the close prices. So these over here, these small dashes, these were the small dashes, these were the stock close prices. Okay, and what you want to do, you want to find the mean of that. Okay, so you find the mean and then you print that. You can see all these 12 months are there because we have grouped with respect to the month, and you can see the first, that is January. The price was average price, closing price is 1750.89. On second, that is February, second month, the average price is 1756. Now obviously this is very hard to understand over here. Let's go and plot it. So if you plot it over here, again y-lim is the y limit, and I want it to be such that you can understand just by looking at the maximum of all the mean prices into 2, so you can have equal distances from the top and bottom, and you have to plot it. So you can see over here it's mostly the same. So on every month you can say that the prices are generally the same. However, generally in June there is how do I know this is June? You can see over here the sixth is what? 6 months is June. It is the lowest. But again, you go over here, you see December, it has kind of risen a little bit in December, and again from December we go back to January over here, again it is still in a decreasing in an increasing slope till April. After April, again it starts going down. So this is what you take an inference from this particular chart. Okay, now this was for return, this was for closing prices. Now what if I want the returns, because we are mostly interested in the return? So again you do the same thing, you say group by month, but instead of close price, now you plot the returns, and then again you take the mean. So you see over here, mostly you have positive numbers. You can see all from January, February, March, April, you have positive numbers. Then for 2 months, May and June, you have negative numbers. Again from July to December, you have positive numbers. So let's plot this over here in a bar chart. Okay, that's why I have said plt.bar. So you have a monthly average return index. So monthly average return is what we had got over here, monthly average return. So you have this over here, and then you take the index of that, and then you plot the values. So once you plot the values, you will see here the same story. You see over here the June month, that is the 6th, that is June. You see the returns are not that good, which means that if you are in the stock market, this is the month you would want to buy the stock, because the stock is trading at the lowest over here, and then you keep on holding it and then enjoy all these increments that you get over here. Again, this is just for educational purposes. Okay, do not invest in the TCS stock. I'm just saying, because this is the TCS data, do not invest in it, but this is just for education. So you will get all these benefits over here till over here, but don't sell it over here. Okay, because you go back to January, again you can see there is positive, which means whatever value you had over here, it's going to increase again. It's going to increase. This is where you sell. Okay, because this is the highest peak. It has gained, the stock price has gained for all these months, and it came and peaked over here. You sell over here again, not any buy sell recommendation, but just for understanding. And then again when the prices fall down till in June, you can buy. This is according to data, not any advice. Okay, now let's come to the, so this was your understanding with regard to returns. Okay, now let's go back to our what we had on the agenda. We had cumulative returns. Now this is an interesting one. Okay, what is cumulative return? In the returns, I had said the formula was basically simple. Okay, you said return on a particular day is the price on that day divided by the price on the previous day minus 1. That was your formula. Now what if I don't want the what if I don't want to take the stock out? What if I don't want to sell the stock on the next day? Okay, so this formula will fail because this assumes selling on the next day. What if I want to buy over here? I want to buy on the first day, but I want to sell on the fourth day, let's say. So then generally what you would say, well, that's easy. What you would say is return on the fourth day, or let's say cumulative returns on the fourth day, because it was there for more than one day. So you'll say cumulative return. It will be the price on the fourth day divided by price on the first day. Okay, so let's say it will be on the fourth day it was 102. So 102 divided by price on the first day, that's 100. So this will be 1.02. So if you gave $100 on first day over here, you will multiply it by 1.02 and you will get $102 on the fourth day. So if you want to find the cumulative return on the fifth day, you will say price on the fifth day divided by price on the first day, that is equals to 108 divided by 100, that is going to be 1.08. So this basically means if you gave $100 on the first day, then if you take the money out on the Friday fifth day, you will get 1.08 in multiplier, and that will give you $108. That is basically what it means. Now the way it is implemented in the way we implement in pandas is a little bit different. Can't we say we just rewrite this? So basically we use daily returns that we have already calculated, which we basically called returns. So this is daily return, okay, daily return, so which we also called symbol returns, and then try to figure out. So can't we say that if I want on the fourth day, that is if I want the return on the fourth day, I will say, let's assume I sold the stock on the fourth day, but I had bought it on the previous day, which was the return, this return. But also assume that I bought it on the third day, sorry, I sold it on the third day after buying it on the second day. And you can also say that, I mean, you can also do is, what you can do is you sell on the second day and buy on the first day. Can't we do that? Because if you do that, you will say P3 gets cancelled, P2 gets cancelled. This will ultimately be P4 by P1, right? Which is over here. Over here, as you can see, P4 by P1. So either you calculate directly, which we do so that it is easier to understand, or what you do is you do like this, which we are going to implement. So how can we change this formula? Can't we add +1 to this? So this formula, let me rewrite it over here again. So let me rewrite it over here again. This was R of t is equals to P of t minus 1 minus 1, right? Let's add +1 over here. So if you add +1, these two gets cancelled, and now what you are left is this, and what you need to do is constant multiplication, as you can see over here. So this is implemented using something called as cumprod, cumulative product in pandas. So let's go back. So we add the 1 over here as I had explained, and whatever data of returns was there, we are going to continue using that itself. Okay, so this will convert it into this format, just r equal to pt by pt of -1. Now in order to find r4, what we have to do, we have to multiply continuously from the from the present day till the first day. This is the entire this is what this particular thing signifies. So that is what we have done in the cumprod. So for every tth day, let's say the fourth day, it multiplies all the previous days to get this particular day return. That is what it is doing. So this is how you find the cumulative product, and if you plot that, you can see the graph like this, almost same as the close price graph, because the important thing is that the range has changed. Why range has changed? Because you are dividing it by the first day itself. You are dividing the price by the first day itself. So the first day it becomes 1.0. I hope you understand. Okay, this was very, very important. So again, just to verify that, let's find the cumulative returns on the last day. So let's say this data, let's say, was for 20 years. So you bought it for let's say you bought the data, or let's say you bought a stock for on the 1st of January. Okay, so on 2000, okay, you bought it at 100, and whatever the price was. So the price is data.close.iloc of 0. 0 is the first, and we want to find the price, let's say on the last day of our stock market we exited the stock. So the last day close price will be iloc of -1. So if you divide that and round it, let's say to 6 digits, we get a certain to say your return, that is 3.072676. and using the cumprod function also, you get the last day return as the same, 3.072676. so these two numbers are the same, this number and this particular number are the same. So that verifies. Lastly, we also need to focus on volatility. Now volatility is something that you will have to understand like this. So what we calculated in the daily returns is actually the movement. It says the daily returns was return of t is equals to pt by pt minus 1. Forget the minus 1 over here, okay, just forget it for this time, it doesn't matter, just subtract something. So what you're doing is basically you are finding the spread. Basically on the denominator you are saying what was the increase or decrease on the first day, something like that, but not fully like that. What happens is um, you take the size of the candle, okay, basically the close and price, whatever, okay. So you see what is if the candle is huge or the candle is small. You can see this particular candle is very high. This particular candle is very high. It means that the the volatility was here, the volatility that existed here was very high. You, if this is a green candle, you came at over here and you went out at over here. This is such a big difference over here, okay. But on all these candles, you see this candle, for example, this one over here, you entered over here and you exited over here. The movement was not very high. Here the movement was very high. So let's say you, this was a green candle and you bought the stock over here and you exited on the same day over here. You made a lot of profits on that day. But let's say on this particular day, even though this is also green, you entered over here and you exited just here, which means you made less profit. So volatility is how much movement in any direction exists on that particular day. That is volatility, okay. Now what we want is not a single day volatility, okay. We can use return function. Almost it gives you the volatility on the single day. What we want is from today look back on a certain number of days. So you don't want a particular volatility on a single day. That's almost equal to the return, okay. What you want is from the first day to, let's say, certain days back, okay. So let's say I was on this day, I want on the last 4 days. So last 4 candles, so this candle included 1 2 3 and 4. You take all these differences, okay. So the return of this, so this one will be, let's say, rt. This one over here will be, let's say, rt minus 1, t minus 1. This one over here will be, let's say, r of t minus 2, r of t minus 2. And this one over here will be, let's say, r of t minus 3. So you will take all those values. You say r of t minus 1, t minus 1, okay, then comma r of t minus 2, then r of t minus 3. You take all of that and then find the, you take all of that and find the standard deviation. Why standard deviation? Because we are interested in the difference, the spread. Standard deviation is the spread, okay. So here if you see, like for example, this Gaussian has a very low standard deviation, but this Gaussian has a very high standard deviation, right? So basically the spread, this has more spread, this has less spread. So more the volatility, more the difference in the stock, the difference in the stock prices. So if you're on the right side of the volatility, you make a lot of money provided liquidity is present. But don't worry about that, we'll be getting into that in the subsequent videos. So that is what we are doing over here. So rolling is basically from the particular day go this many days back. But rolling, what also means is, let's say you were going forward, okay. So let's say your window is 3, so you want to calculate the volatility for 3 days. In rolling, what you do, you don't skip the 3 candles and move to the 4th candles, okay. So from here 3, you don't do this. What you do is you skip 1 candle and then take the next 3. So you left one and you added one over here, okay. So in the first one, this candle, this candle, this candle were taken, and the second one, this candle, this candle, and this candle will be taken, okay. In the third one, this candle, and this small candle will be taken. So this is how it moves. So this is rolling. Now the size, that is window, is basically, so here we took 3, here we have taken 30, okay, and then we have found the standard deviation over here. So this is going to give you the rolling volatility. Fine. Lastly, what you do is you also figure out your so on certain days you can see the volatility is very high, okay. I think these are the ones that saw a lot those crashes, that is the gap downs that had occurred. So you can see over here that the prices have fallen down very much, okay. The volatility is very high, it means the prices either shot up very much or shot down very much. That is the entire idea. Fine. So you can also plot the histogram over here. Now volatility, since it is in the standard deviation, it has to be positive. So you can see volatility is close to zero but not very high, but here you can see this is almost 10% volatility. This is very, very high. Okay, so this over here is not even 10%, like it's very high. So bins basically is equal to 100. Here volatility is high, which means these are your big gap ups and gaps down, or on, you know, some sudden news has come that has shot up or down the prices. But for the most part, the end most of the density is over here, which means that your volatility is okay. It cannot be zero, it cannot be negative. Zero means constant, obviously not possible. There has to be movement in the market, so your volatility is somewhere over here. So I hope you like the video. In the next video we will be comparing for, you know, more than one stock, 3 4 whatever the number is, and we'll be trying to see some more things, but this video is going to be the basis for all the next videos. So thank you very much.